Hello, good afternoon, and thank you for joining us for another Bot Creator Meetup. Today we're going to have a slightly shorter episode than we usually do, but we still hope to give you lots of new insights, and we also have quite a couple new things and developments that we want to discuss with you, and some good news. But if you have any questions in the meantime that you want answered or due to story, please let us know. You can just drop them in the comments, and we'll get to them. So one of the really cool things that we talked about last time was that we have now successfully registered the first TradingView bot creator. This bot creator is now actually already on the platform. The bots from this bot creator are the Ethereum Max and the Bitcoin Max. And everything is up and running. Everything works smoothly, so we're very excited. We actually already have a couple more bot creators from TradingView joining us in the quarantine, which will be released hopefully in the next month, and we'll look forward to welcoming them as well. So now, well, as all of you will most likely know by now, we usually use our API for executing the transactions. And we want to add as many options as we possibly can for you to connect your algorithms, like if you're hosting on different platforms, for instance. TradingView was a really great achievement, so we're very proud of the fact that we now have running successfully. In addition to our standard trading API. And we also have some very good news for the meta traders among you. If you haven't heard about MetaTrader yet, look it up. It's one of the biggest platforms there is. And if you are using MetaTrader, then I have wonderful news for you. It has never been easier to get your algorithm on the bots platform, because we have just finished making the API, making a bridge for MetaTrader 4 and 5 to the bots platform. So if you are running on Meta, what this means is that you can download the Expert Advisor, and then you can quickly get set up and start running your bots in the quarantine, and then hopefully putting that live. And a lot of work has gone into this, so we're really happy that now it's working properly. We're running the first bots in the quarantine now, and hope also to be welcoming them shortly on the platform. And as most of you will most likely have seen, we've been adding quite a lot of bots recently. We also intend to keep up the pace and increase that pace. Hopefully by also joining by putting your algorithm on the platform as well, so that you can get exposure to our clientele. And there's obvious, we've been working on a lot of different ways to get connected, but that doesn't mean we're going to stop just at MetaTrader, at the Meta Bridge. So if you have a platform that you're running your algorithm on and don't know how to get connected to our system because API calls are, for instance, not supported or very complicated, please let us know so we can have a look at if we can incorporate the platform that you're using into the bots way of working. So we can just investigate and try to make it as accessible for everybody as possible. And so on bots, currently we are mostly trading, we're only trading crypto assets. And up until now, it hasn't really been possible to trade the different types of asset classes like Forex and equity and commodities, etc. So we also have a major development in that coming up very soon that will allow us to start testing a system where we can trade those equities and commodities in the Forex. So we hope to, by doing this, create a much larger market for ourselves and for the users to trade on and the bot creators to trade on, as not crypto is still kind of a niche, though it gets a lot of attention recently because of, well, exploding prices. Doesn't mean that there are significantly more algorithmic traders on crypto than on equities. Quite the contrary, most traders that do algorithmic trading stay away from, well, not necessarily stay away, but are more, the most of them will be focused around equity, forex, etc. And we also want to be able to provide a platform not only for the crypto for the users, but also for and bot creators, but also for all the other assets to trade. Which kind of brings us to the first talking point, which is choosing what asset class you're going to trade, because there's so many different types of assets that you can possibly trade on in the world, which can make it a little bit difficult to pick which one suits you best. However, when you're writing your own algorithm and trying to decide what you which asset class you want to do, it all depends on what kind of trader you are, what kind of what's the basis for your algorithm. Because some algorithms might make really a lot of sense for equity markets and for forex, but just do not make sense at all for cryptos. So it's always good to keep in mind that your algorithm, however you develop it, will perform quite differently on the different assets. It can, obviously, there's lots of similarities in market movements, so good chance that it will still run, but might not run as effectively on one asset versus the other. Because if you compare, let's take a very specific example, which would be a gap and go or a gap close, which means which is very specific to for the equity market. Because what happens is when an equity stops trading at 4 o'clock in the afternoon in the US, for instance. Overnight, there can be quite some movement in the stock. So it can jump up and open the next day at 9:30 US time at a much higher or lower price than it was trading previously. And you can write algorithms specifically to take advantage of that gap, of a likelihood of that continuing that direction or completely reversing back to the previous close, which is a gap close. And as the name kind of says, a gap and go goes the other way. It gaps up, for instance, and your direction is bullish, so you're also going to go up. Vice versa would be the same. Gap and go can also go for the downside when it opens a lot lower than it closed, and then you expect the move to continue. Obviously, this depends on a whole lot of different variables that you have to decide yourself. But I hope this kind of illustrates that there are specific things you need to keep in mind when you're picking your asset class. And what's good to keep in mind if you're picking crypto, that the volatility is really high. And if you're coming from forex, it might be some adjustments for you to kind of get control over that volatility, but also the commissions. Because the difference between the commission that you pay on a forex pair is quite a lot lower than that you do for crypto. So when you're used to doing, I don't know, let's say 10 or 20 or 30 trades a day, this is all fine and well within the forex market because the spreads are very low if you have the right broker and account. Obviously, that depends a little bit on the broker itself, but strategies that make sense in that type of environment don't necessarily make sense in crypto because the commissions are so high. But you can see it like this: if you pay 0.2 to enter and 0.2 to exit, and you do that 10 times a day, you're going to have to make a profit of 4%. So that is your minimum, and that's the break even. So anything below that means you're in the red, which can cause quite a bit of downside if you're not taking this into account properly. And when you're trading with when you're trading on the crypto market, what's also very interesting is that the swings are quite a lot larger. But keeping in mind those commission offsets, you're going to most likely want to trade a little bit less, because like I said, the amount of trades that you do in forex are with lower spread, but usually also with a low return. Where a crypto coin can bump up and down 10-20% in a day, that doesn't happen that often in the forex market. is better said. The last time that a forex jumped 20%, that was a pretty big deal, and everybody was in panic. This was years ago, but you need to be aware of these little differences. And what also this actually brings us to the next talking point, because we are mainly crypto trading. So I do want to talk a little bit about the importance of getting in at the right price. Because with crypto, not only are the commissions higher, but your slippage and chance of you encountering slippage or not getting in on the right price are quite a lot higher because of the lack of market liquidity. Because for every trade you want to do, you need to have somebody that wants to either buy or sell to you. And what then happens if you're trying to buy for a specific price, and there's, let's say you want to buy 100 or something, but there's only 10 available for the price you want, you will never ever get that full fill that you intended. What's very good practice is to determine like how much am I really willing to risk on any specific trade in terms of slippage. Because if you have an algorithm that where the average return on the trade is 10%, then an extra 0.5% slippage will most likely not kill your entire trade return. However, if the goal of your algorithm is to make smaller steps, like 1 or 2%, you can't really set that limit price that high, because you're going to kill your overall return if you get a couple bad fills in a row. So the idea here is to balance your returns that you have on how much do you really want every trade to have a full fill. Because if you do have the space for extra for extra loss of percentage, so to say, with the slippage, then you can actively try to get a larger part of your order filled. So when the price hits your limit price, you get a partial fill, but you still have all of these assets left that you want to use in your trade. Then what you can do is you can check how much actually got filled, and do I want to take the risk of sending another limit order with a higher price and get more filled for a higher price. However, this completely depends, like I said, on your overall risk to return ratio, with how much upside and how much average downside you have per trade. And what's also very good to keep in mind is that as an individual trader, you are not so likely to encounter the large impacts of these liquidity issues, so to say. Because when you're trying to push 10 or 20,000 euros in the market, it's not that big of a deal. However, when you're trading for bots, with bots, for instance, our positions are quite a lot bigger. So it will happen a lot more frequently that you can't get the right fill, because there's just not enough people, not enough market participants to make sure that your trade makes sense. Because you, like we said before, you want to get in to the trade, but not at any cost, if that completely kills your risk to reward ratio. And the higher the assets under management is, the more likely you are to run into this issue, which is also why we put a market cap on the bots. Something that has been discussed quite a lot is the liquidity model. That is something that helps us guide to, the market cap. The liquidity model is something that calculates how much market depth there is on average, and this tells us what is the maximum amount that would be safe to you in terms of position to get in and out of those markets. And when you're when we put the market caps, this is for a large part decided by this. However, just because we allow that amount to be traded doesn't mean that you can actually dump that entire asset, the entire amount of the assets into the market, because of your limits by the market itself, which can vary quite wildly, and this is why it's very important for you as a bot creator to determine what is the minimum price or the maximum price that I want going into the trade. And what is a nice technique, because you want to get you want as much of your portfolio exposed to the market. What's a nice technique for an algorithm running on the bot platform is that you did not try to push everything in one single asset. So, for instance, Bitcoin there's a trigger for Bitcoin, and you go all in Bitcoin. Though what we see with quite a lot of the algorithms that we have online now, which we call the portfolio bots, is that you look at different assets. So it can be up to 10 or 20 coins, for instance. And when you run your algorithm on all those different coins, in this picture, obviously, overfitting is really important. But the benefit of doing this is that you can run your algorithm with a much larger market cap, because when Bitcoin triggers, you don't put your 100% in there, but you put 1/20th or 1/10th of your portfolio into that asset. And this makes sure that you can still keep your algorithm running, and quite often, because you want to do a lot of trades. You want to get those positive returns. And the only way to do that is to have true market exposure. And the nice thing about this is that you can doing this, you can deploy a lot more assets than you would be able to do otherwise. Because as you can imagine, dumping 100,000 euros into a market wouldn't be that big of a deal. But dumping $1 million in the same market might be a little bit trickier. So if you do it in 10 different markets, it's kind of the same as spreading it over different exchanges, your orders. Because you're trying to make sure that you're not influencing the market, that you're getting the right fills, and that you're not overpaying for your trade. There's another benefit to doing this, because in general it lowers the risk that you are exposed to, because it kind of averages out the returns. So it decreases the volatility of your bot, because when you're comprising a bot of basically multiple algorithms running on the same algorithm but on different markets, then the jumps up will be less, but the jumps down will also be less. So it just averages everything out, and that just decreases the volatility and can give a little bit more of a comfortable feeling for the users. What could be said as well is that, like, if one algorithm runs extremely well on one asset, but a little bit less on the other assets, then you have some loss of you can have some loss on the performance. However, it's obviously up to you to decide whether or not that loss of the performance is worth or I should say potential loss of performance is worth the decrease in volatility, as that can also be very attractive. As a bot that has low volatility, stays out of crashing market, that is much more likely to attract the type of user that would want to put larger amounts into your bot. And for this, we also getting those larger amounts in your assets as assets under management as deposits is, from bot creators' perspective, one of your main goals, other than making good return for the customers. So it's really important to promote your brand properly. And what I mean by saying this is pick the right name. It has to be something that, because what's in a name? Not that much initially, but from a consumer's perspective, it's just a name, but it needs to be interesting enough for them to remember it or make them curious. So it can be something funny or anything like that. But it's good to have strings of names. For instance, the Aga team has a whole list of ladies: Wonderful Wanda, Luscious Lola, etc. And that really stimulates the user to be familiar with the product, gives them a more comfortable feeling. But in addition to this, it's really important to make clear what your algorithm is doing. Who are you? What's your team like? How did you get to where you are? Do you have a lot of experience? What drives your algorithms? And just to try to give the customer as much information as they could possibly need to make an informed decision on whether or not they're going to start with your bots. And it really helps to do things like podcasts and interviews and posts, but most of it will come down to the description. And because when people open your bot, the first thing they see is the name. When it just comes on the platform, is the name and the team name and the description. So those are your first points of contact. So you want to make sure that those points of contact go smoothly, that what you say is interesting enough to force people to remember it actually, and also be interested in finding out more about the bot and giving them a confident feeling about the algorithm that it will make a success. Because just like any other bot, when you come online the first time, you're not going to have that history built up yet with the platform. Because what you see with a lot of the bots that have been on the platform for very long, that have solid returns, they're very popular. They're quite often full because they have such history with the platform, and it gives a more comfortable feeling. So especially when you're new, it becomes really important that when they read the description, they completely understand what your algorithm is doing and who you are, what the team behind the algorithm is. And to make maximum use of that, we always like to invite you for a podcast before you go live on the platform, so that users can not only read your description but also get full story behind you and your team, and why the algorithm works as it does. And I also wanted to note one more thing that is about it's a little bit off topic from this, but it's about the scenario training for your algorithm. And there were some questions about this, so I wanted to get into it a little bit more, because when you're making your algorithm, a lot of people tend to pick a specific time frame and train their algorithm on this. And to get an initial feeling of what your algorithm does, how it works, how you can possibly deploy it, what does work, what doesn't work, this is all fine. However, when you're going to be, when you're getting in the later stages of the development of the algorithm, you're not only going to have to send like large data sets from 2017 till now, but it's also important to send to test the different fragments, so you can not only see what is the overall performance of the algorithm, but also identify the behavior of the algorithm in specific markets. Because this could expose, one of the things this exposes is overfitting. You don't only expose overfitting by testing other coins, but you can also expose it by running different scenarios. So if you have a piece of data that is run that has a very big bull run in it, it's going to behave completely different. It might behave completely differently from a scenario where you have a flat market or a crashing market. However, we can't see the future, and it's actually not our jobs to try to see the future, but we do need to be prepared for any kind of market. So what will happen to your algorithm if we suddenly drop into a bear market for 2 or 3 months? Then go flat and then run up again. What will it do in the in that time frame? Because you're trying to make, as a trader, you're always trying to make profit, regardless of market conditions. All you're looking for is volatility, so that there's a lot of price movement. This being said, doesn't mean that you can't make money on low volatility market, because there's lots of very good mean reversion trades that you can do to take advantage of markets that go up and down and sideways for a very long time. So what you do is you take the data set, you take just the historic data set, and you need to identify different blocks, because as a human it's quite easy to say, okay, historically this is an uptrend, this is flat, this is down. It's good to chop those up into little bits, but also not only run on those individual blocks. You can pick a bear market from March 2020. You can pick a bear market from a little bit earlier this year, which wasn't really bear market, but a correction. You can take some data from 2017, etc. So it's really good to look for those specific for those different points in time where you can use the data from to try to make your algorithm as robust as possible. And then it's going to be up to you to decide which one of your algorithms has performed best throughout all the scenarios. As this can also be, doesn't necessarily have to be that you pick the one that performs best on every single scenario, but you do need to be aware of what is the preference of your algorithm. So if your algorithm does fantastic in flat markets, doesn't do so well in bull runs or bear scenarios, you can try to plan to how do I keep my algorithm out of those markets. Or on the other side, you can also try to make it extremely clear. If you make it really clear to the user, hey, when the markets are flat, get into this bot. It's going to do very well, very good returns. But in bull runs and in bear markets, it's just kind of flat. That's also okay, but then you need to be able to communicate that to your user. Same thing goes for when your bot does extremely well in bull or bear periods. This is just a way of you can just communicate this to your user and tell them what your expectations are of the algorithm in the different market conditions. And the last topic that I want to get to before I saw some questions coming in. I'll get to those later. First, I want to take the last pick for today, which is about the time frame. The time frame is the standard is to use a candlestick and get a time frame for that. A candlestick is nothing more than a visual representation of the open, close, high, and the low of a specific period. This period we call the time frame. This can be many things. You can pick it however you like. This can be a minute, this can be an hour, this can be 15 minutes, 30 minutes, weeks, days, months, whatever you want. And it's important to keep in mind that your algorithm will behave very differently on those different time frames. So bots that do well on swing trades might do quite a lot better with 1 day time frames, or 30 minutes or 60 minutes. 30 minutes might be a little bit of a stretch for a swing trade, but for the more fast-paced algorithms, it could be that your algorithm is most suited to the 5 or the 15-minute candle size. And that just really depends on how your algorithm runs, because just because you trade on a lower time frame doesn't necessarily mean you are going to trade more. It quite often does, but it doesn't have to, because if your indicators are set up for a very specific event that doesn't happen that often, regardless of the time frame, then you're still not going to get triggered every minute or every 15 minutes or every hour that the algorithm runs. So it is very important to have a look at this, because if you have an idea that doesn't seem to work that well on your chosen time frame, but you're confident in its abilities, it's always good to have a look at how does this perform on the different time frames. One of the tips I would give you when you're doing this is that when you're scaling time frame, it depends on what you're using as an indicator or how you construct the value. But when you shorten the time frame, this will most likely also be very influential for the periods that you measure for any kind of indicator that you use. Because if you're trying to measure something, a value that's on a daily basis, like the volume, then if you go in a shorter time frame, you're no longer going to be using the volume of the higher time frame. So it's good to have a look what this means for your algorithm. So I would like to get to the questions, and the first one is from Edward, and he asked if that he's a huge fan. I'm very happy to hear that because we always like to have such an involved community. His question is when we're going to be adding shorts. Shorts is definitely something that we're looking into because it's really important to be able to provide a market for also the downside opportunities, because you don't only want to be like you can't only there's more ways to make money than just the upside. You could just make money when the market goes down, which for a lot of crypto skeptics would be like music to their ears. This is, however, not as easy as you might suspect, specifically for the crypto market. And this has taken quite some time to develop. We are developing this feature as of this moment. However, it will not be live yet for the next couple of weeks. So we are really working on that and really hope to be able to offer shorts as soon as possible. But it also needs to make strategic sense and technical sense. So we need to be able to execute it perfectly, as we don't want to carry excess risk or have our customers get exposed to excess risks. And so Charles asks a question about what happens if the Bitcoin crashes 30%, if the bots do get stopped. Yes, this actually does happen. It depends very much on the algorithm on when they actually get out. But for instance, we had a pretty significant correction a couple of weeks ago. And during this, you could clearly see that the bots got out quite a lot sooner than I would have expected. Which was really nice because the market was down, I believe, 25%, and my portfolio was down only 5%. So it really shows that these algorithms do have a really good eye on the market and do get out when they need to. And the benefit of this is clear because crypto is really cool, that it's exploding. That's really awesome, and just creates so many wonderful opportunities for users and bot creators to take advantage of. But you do want that downside protection, because all these runs up are really great, but they also come with hard drawdowns, and you don't want the exposure to that. And what if even let's say Bitcoin drops 50% overnight for some reason? Then you don't want that exposure. You just want to get you have taken advantage of the way up, and then you can take advantage of the way up when it will eventually make some move. Because it is extremely unlikely that things drop down straight like a rock. Even when the oil futures went bananas in 2020, it didn't go down straight as a rock, and yeah, there were always pauses in it, so you could still make a return on the upside. However, that was quite risky, but there were quite a lot of opportunities on the long side, even for that crashing market as well. And well, that concludes the questions, and that also concludes the Bot Creator Meetup for this time. If you have any suggestions, questions, if you are a MetaTrader, please get in touch with us. Drop a message in the comments, go to our Discord, our webpage. You can send smoke signals and we'll try to respond to all of your questions and comments you might have. And have a good evening.